US Federal Reserve decides to hold steady the target range for its benchmark rate at 5.25 to 5.5%. So what are pundits saying about this latest rate freeze? When is the Federal Reserve likely to begin rate cuts? And how does the Bank of Korea look to chart its monetary policy? Welcome to Thursday's edition of Issues and Insiders. I'm Min Sunhee. Today we touch upon monetary policies here in Korea and over in the US amid efforts to ensure economic stability and growth. For this, I have Professor Kim Sei-wan at Ewha Womans University live on the line. Professor Kim, it's good to have you on.
Thank you for having me today.
I also have Professor Song Soo-young at Chung-Ang University live on the line as well. Professor Song, it's great to see you.
Yeah, glad to see you again, and good afternoon to you.
Right, Professor Song. We'll start off with you, Professor Kim, then. How do you respond to the U.S. Federal Reserve's latest decision?
As expected, the Central Bank of the United States left its benchmark federal fund rate in a range between 5.25% and 5.5% on Wednesday, where it stood since July of last year. Also, Federal Reserve signals interest rate cuts are possible, but not imminent, as it holds rate steady, which is a disappointment to Wall Street. With today's decision, the Federal Reserve has held its benchmark federal fund rate steady at 4 consecutive policy meetings. They began raising rates from near zero in March 2022 and lifted them rapidly, most recently in July 2023 to the highest level since 2001. In its policy statement, the Fed said the risks to achieving its employment and inflation goals are moving into better balance, and it outlined how changes to its economic outlook could prompt adjustment to the target range. That was a more neutral description than previous references to the prospects of additional policy firming or higher interest rate. At the same time, Federal Reserve signaled the shift in its outlook shouldn't imply a rate cut imminent.
Right, indeed. It said that a rate cut was not in the picture in the near future. That being said, Professor Song, what are your thoughts on the timing of a rate cut by the U.S. Federal Reserve, and what look to be the broader implications of such cuts later this year?
Yeah, it's quite difficult to make some forward-looking because whether the Federal Reserve is going to decrease the federal funds rate in sooner or later. Currently, according to some kind of data, what matters most is likely some real interest rate is quite high because of the, as is seen in the previous broadcasting screen, that the CPI consumption price index has been dropped lower than even 2%, which is in 2% range. So that means real interest rate is going to be very large, which is a burden to the household, debtors, and investors. Clearly, real interest rate goes up. It means the investment activity is dramatically reduced. So considering that part, that is the Federal Reserve is going to think about the timing of the reduction of the federal funds rate. And clearly, according to the yield curve, which has shown the relative status between the different maturity bond yield, particularly the 30 years, 10 years, currently the 10-year bond rate is hovering around 4% something, and two-year interest rate is still lower than 5.5% federal funds rate, but is a little bit higher than the 10-year bond rate. So the spread between the 10-year bond yield and the 2-year bond is negative 0.44 percentage point, which implies that yield curve is inverted, which means the traders in the bond market make a prospect in the future the interest rate is going down, and that is reflected in the yield for the bond. So another issue in the Fed is Federal Reserve. I some economic newspapers such as Wall Street Journal has anticipated some remarks by the Powell about some quantitative tightening, which is the direct opposite of quantitative easing, which means that normalization of the Federal Reserve account, which means they would like to sell their assets, such as which was purchased previously under the policy of quantitative easing. Then since 2022, and Federal Reserve tried to normalize and selling their purchased assets to the market, which means that actually reduced some speed of the future long-term yield curve, yield interest rate to drop down. There is a break. So considering that effect, actually market may respond much bigger, and they anticipate bigger interest rate cut. Therefore, currently the Jerome Powell has been very cautiously predict, and as Professor Kim has already mentioned, no imminent rate cut is expected. But considering development of the data and the economic situation, and particularly the unemployment rate and the quit rate, considering those factors, then it's still possible that the 50-50 chance to decrease the interest rate in the first half, and not in March, maybe next time.
Right, I see. And against this backdrop, Professor Kim, it appears that here in Korea, our own monetary policymakers have also adopted a cautious approach to rate cuts. How do you explain the Bank of Korea's prudent approach?
Well, since Korean economy's growth momentum is pretty much weakened from last year, there are many reasons for Bank of Korea to lower its key interest rate below 3.5% of current level. Last year's economic growth was about 1.4%, and this year's economic growth is expected to be about 2.2% according to government forecast. And the need for additional rate increase has been reduced as inflation continues to slow, and risks related to international oil prices and overseas risks like the Middle East crisis have been alleviated. But at the same time, lower interest rate might cause many other problems, like stimulating an expectation of real estate price increases and household debt increases. Also, lower key interest rate of Bank of Korea heightens the interest rate gap between U.S. and Korea, which is 2% as of now. When the base interest rate gap increases, there can be problems in exchange rate control and capital outflow by foreign investors. So I believe that Bank of Korea would cut its key interest rate after seeing Federal Reserve interest rate cut in the first half of this year.
Right, I see. And yet in the meantime, the Professor Song, there are some pundits here in the country who claim that early BOK rate cuts are necessary to perhaps ease the pressure on real estate projects here in the country. What do you say?
Yeah, considering the chairman Lee Chang-yong's response when the United Federal Reserve decided to increase the interest rate, as a preemptively, he decided to increase interest rate in Korea earlier than even the United States has not yet increased the interest rate. Then why not try early decrease of the interest rate for the BOK? Still, the problem is, according to data, our economic GDP growth rate is really very worst. I mean, 1.4% in last year. That is really even lower than Japan. And not to mention the United States, which has shown a very strong resilience and the very recovery of the economy, 3.3% GDP. So currently, Korea is, even though recently IMF outlook of the update of the economic growth rate will be increased by 0.1% for Korea and some other countries, but that is considering the easing of the inflation pressure, and then As long as the current geopolitical situation has become stabilized, then the outlook is very good. That's why the IMF has updated their outlook for the world economy, and there is a positive increase. And considering the January 1st month of the 2024, our export has been increased by 18%, which was remarked in the earlier the broadcasting. So that is very impressive, but that is only limited to some high-level, high-value products such as semiconductor and also auto export cars. But considering domestic economy, this is a really bad situation. And even though unemployment rate for South Korea has remained relatively very low percentage point to 2.6% for the past from early 2023 January to the end of the October of 2023, but it has been dramatically increased from the 2.5% to currently 3.3% within just 2 months. And even though I couldn't check the quit rate or vacancy rate on Korean labor market, in the United States, clearly the labor market is not anymore tight, which means that quit rate has been reduced and smoothly declining, which means people who are employed, they believe that their prospect of finding a new job is not good, then they would like to stick to what they got right now. That is the point we should see. So considering that situation, in South Korean economy, we have to consider right now, our domestic economy is in almost on the verge of recess, even though the export has camouflaged and make some added up the cosmetics upon us, foundation upon us, our economy face. But actual face is really bad. Therefore, that's why the Bank of Korea should decrease the interest rate at least earlier than United States. That is a really necessary step.
Right, I see. And staying perhaps also with concerns regarding the domestic economy, Professor Kim, what are the prospects of a wider real estate crisis amid the woes of troubled Taeyong construction?
Korean real estate market is now experiencing one of the most difficult times since 2000 for high interest rate and growing risk on real estate project financing defaults. It is true that Taeyong construction's crisis signals a possible further crisis in construction industry and financial firms. And since savings banks and security companies provided larger size of real estate project finances, the risks of these firms are rising quickly these days. But as we have seen in earlier in the defaults of Legoland's related bonds in 2022, Korean financial supervisory authorities are taking preemptive actions to sort out risky real estate projects finances to contain the spread of financial defaults. I think it lessens, of course, the overall risk of a real estate market defaults, even with Taeyong's crisis. But we need to watch out the progress of the project finance situation, whether it worsens further or not. Otherwise, there could be further project finance crisis in both of the financial market and construction industries.
Right, so better monitoring is needed on that front. Professor Song, moving forward, Korea and the US, they've held their senior economic dialogue on Wednesday here in capital Seoul. Among the diverse matters addressed, Professor Song, which issues do you believe are crucial to ensure bilateral economic stability this year?
Yeah, first of all, I wonder why it is called some economic discussion, because the counterpart of Korea is actually the vice minister of the United States is foreign minister. I mean, Department of National State, state minister. So Fernandez, he has visited Vietnam and the Philippines, and the final leg is Korea. So this is not, I don't think this is actually economic issue. Rather, it is a security issue, but economic issues are maybe discussed because of some rare earth materials and usage of particularly for the battery and the other things. The Chinese products or Chinese materials should not be used to maintain some favorable states in the trading. So this is actually, even though it looks like some economic talk and the trade talk, under that the truth lies in some kind of diplomatic and some security issues, which is important for particularly for the United States. And by the way, anyway, in order to, as long as our Korean government has maintained a little bit, not hostile, but is less friendly status and status against China, we may not fully exploit or make use of the current geopolitical situation, because we have emphasize or put too much weight on the U.S. and the other some Western countries. So Western European has suffered so much from some almost a recession-like economic low growth rate. And so United States solely has made us really impressive progress in economy. That is at least good news but for the domestic economy, what is more important is relationship with China. So as long as China is expected to move up and some Chinese government you make use of some fiscal policy and they decided to just let Hyundai to fall into bankruptcy and remove some kind of obstacles and some problems, then the FDI will come back. And to that regard, our economy should rely or should make use of all these development on the progress of the economic situations.
Right. Well, Professor Song, you've always talked about the importance of balancing our relationship with our neighbors. Professor Kim, staying then with Korea's alliance with the U.S., concerns have been raised over Korea's planned efforts to target monopoly of major online platforms. Could you tell us a bit about the concerns that have been raised, and how do you respond to them?
Well, it actually is a hot potato between U.S. and Korean government these days. From long time ago, Korean government is about to enact a Platform Fair Competition Act, which aims at banning unfair activities by monopolistic online and mobile platforms by influential players, which is monopolistic providers. Along with this new act, it is possible that U.S. companies such as Apple, Google, Amazon, and Meta, also Korean companies like Naver and Kakao, could be among those included in the influential players. But the U.S. private corporations that runs business in Korea, represented by Korean American Chamber of Commerce, said that it is crucial that full text of any proposed legislation should be made publicly available, and that the Korean government needs to provide ample opportunities for engagement with a range of stakeholders about this act. On this matter, Korean government's Fair Trade Commission empathizes that its officials met twice this month with members of the American Chamber of Commerce in Korea to discuss the planned platform regulations. And they say that they are ready to reflect these U.S. firms' concerns on the new act. So as the situation develops, there could be further conflicts between U.S. and Korean governments.
Right, indeed. So negotiations will probably take place once the law has been framed out then. Meanwhile, Professor Song, as you mentioned earlier, the International Monetary Fund has raised its 2024 growth outlook for South Korea to 2.3%. Very briefly speaking, Professor Song, what do you believe has fueled this upward revision?
Yeah, because the world economy outlook is improved a lot because the inflation pressure has been eased and supply disruption has been resolved. Therefore, the supply side cost has been dramatically dropped, and it goes back to what it used to be before the pandemic outbreak of the pandemic. So, and also the expectation of the growth rate, particularly in African countries, and in the European countries, which has experienced the worst season, and then the geopolitical problem in Ukraine and Russian war has been stabilized relatively. So considering those situations, then the IMF has revised the outlook positively, particularly for the Korean economy from 2.1% prospect to be increased by 2.3%. That is good news, and that may have some sentimental effect on the Korean economy, and then the Korean domestic economy demand is improved. That I think that is very positive. It could have a positive effect, but it should be accompanied by the decrease of the interest rate and the relief of the real interest rate burden for the household. That is the key aspect which should be emphasized in Bank of Korea, for the Bank of Korea. I would like to emphasize finally about the statement of long run for the Federal Reserve. It starts with the employment. Maximum employment is the most important mandate for the Federal Reserve, but not for the Bank of Korea. So that difference creates a very big divergence because when the interest rate is high, and it means that the real interest rate is high also, and inflation goes down, the non-accelerating inflation rate of the unemployment is the so-called natural rate or neutral rate is very important. That means from the Fed is going to maintain the highest employment unless it triggers the start of the inflation. That's why they would like to decrease the interest rate as long as inflation is not started. But however, in Bank of Korea, they don't have such mandate. That is very critical difference, I think.
Right. So, Professor Song, your opinion is the Bank of Korea should chart its own monetary policy depending on internal matters here in the country then. As always, Professor Song, thank you so much for your insights. And Professor Kim, thank you very much for your time and your thoughts.
Thank you. And Happy New Year to Professor Kim.
Right. Happy New Year to both of you. All right. Well, that ends this edition of Issues and Insiders. Thank you for watching. See you same time tomorrow.